have a quick recap of what we mentioned last time and how we're going to move forward from here and onwards. Very important to consider that last time, as we expected it, and also as we all agreed on it, there was a very significant level of triple bottoms or triple points, whatever you want to call it. As far as the market is reaching a level over and over again, eventually it is going to be breaking. So that's where we ended our last meeting, where we understood simply the fact that the market has been already reaching the same level over and over again. The only thing that's happening, there's really traders are just starting to stack up all of the orders there. More stop losses, more traders trying to go and take selling positions. So traders who are taking the buying positions, they are pretty much placing the stop losses here on the bottom. Traders who are trying to take the selling position, the breakout traders, they are placing the sell stop orders on the bottom side. Because of course, we have two types of traders every time. The ones who try to buy when the market is finding that support level in the market. So they expect the market to be moving higher. So in that case, one of the reasons why the market should be going lower is, of course, the stop losses that they place. Because the market has a nature, and the way the market is going to be working is there are brokers, and brokers are connected to liquidity providers. These liquidity providers, they have an automated engine of the market constantly moving to where the orders are. That's simple as it works. If the market has orders at a certain price, automatically the price is going to move towards that area. So very often, when determining these market directions, it is quite important to get a sense of where the market may potentially be heading towards, with a logic of where other traders may be interested of selling or buying. And of course, with that logic, because we understand the logic of these triple bottoms, as I mentioned, some people see it as a support level. And of course, they try to buy. So naturally, the stop losses are going to be on the bottom, which the market has to take eventually in just a matter of time. The other thing is the selling traders, because of course, on the other hand, we have the breakout traders, which basically means that if something is having a price level that is touched over and over again, it is understood that if the market happens to break it the next time, it usually happens to be a large impulsive move. So that's the breakout traders. And those breakout traders are placing the sell stop order, which is the automated order by the trader, to automatically execute the position once the price is heading towards that level. And that becomes the other reason of why the market should have been moving lower. Other than that, the other thing we also spoke of is really going back all the way to the roots of the market, of how the standard market nature is working. This massive gap just got filled. We can pretty much perfectly see how that was the other reason why the market came lower. Other reason is pretty much having a logic of support resistance, which is a real concept. Like, do not ignore support resistance. Very often, the market does indeed work according to that logic. And I can tell you, it seems like we are heading higher because of the support level the market was finding here at one time, because of course the same level was a resistance sensitive area at one point. So logically, it has to be a resistance sensitive area the other time. So these are, of course, very common information, kind of that basic knowledge everybody knows. But of course, it is kind of ignored because no one wants to comprehend that many times these simple theories of the market are indeed the main market driving factors. So right now, this was completed. Of course, it is understood that we rejected that level completely. And to me, the main next direction defining move and the next direction defining analysis is really understanding if how does today today's market close. If I'm gonna, of course, have a very strong candle here on this daily time frame, which is of course the daily time frame, if the market happens to confirm me that for the end of the day, this level that the market just rejected from here, which is, let's just mark up what are those things. So obviously we got this massive gap filled. We of course got the resistance in the market completed. So naturally it has to go higher. So how would I confirm in the next couple of days the market should indeed move higher? If today is closing the same as you see it right now, the candle is considered as rejecting from that point. If today the market will not be closing in a way that this candle is of course heading higher, and clearly we see how that wick was like bouncing off from that level, like it bounces higher. If that doesn't happen and maybe the rest of the day just crashes lower, we cannot really confirm any sort of buying trades for the next couple of days. But of course, if this happens, if today is closing accordingly, it is indeed very, very important. Many times these wicks and these candles are all considered important. And as far as the market creates any sort of significant bounce from a single level, it is of course going to be something to look out for because it may potentially confirm a much longer term trend. Like, what if I'm telling you that this candle here, if it's closing like this today, we are moving higher. But what if I'm telling that it also happened in the past year? If you look back at this candle in the market, it basically bounced off from a level. Like, what a reason it bounced off from. I mean, I can tell you the reason why it did it, but I just want to make sure that things are kept a bit simple here, without going into too many overcomplicated stuff. So of course there was a specific reason of why that happened. Obviously, mentorship students most definitely know. But of course, if you notice why this kind of did that, it created a massive trend lower. So now that we see pretty much the same thing, wouldn't you say that the market has a high chance of reverting more back to the upside? Of course it does. Of course it is going to be reverting more to the upside. So that's going to be very important for the next trading week, and also it is going to be important for the next couple of months, of course, because these sort of things are very long-term movements. Like, if you take a look at how long it took the market from this point of rejection candle to be moving down here in the bottom, it's like more than a month. Like this was more than a month ago. And exactly a month later, the market is basically bouncing back to the upside. Which I'm more than happy to hear it. But of course, like, guys, like, what if anybody disagrees with me? It doesn't really matter. My opinion is going to be my opinion. So speaking of that, like I mentioned, market basically rejected from this level is something to definitely mark up because all right, I'm gonna attend to this a bit later, and after that we're gonna fix the problem. We're gonna figure it out, of course, a bit later. We don't want to waste some time with this for now. And after that, I'm gonna make sure to get things better moderated. So that, of course, goes back to real chart. So we're gonna go here. So again, like I mentioned, it is gonna be very important to mark this level up because, of course, this level here is going to be okay. Let's go to different chart. Very simple. I mean, if anybody doesn't see this, you're freaking blind in the market. Very simply, we're gonna head easily at least here, which is of course gonna be a main important level. Minimum. That's very, very visible. Very nice to see that. This point of consolidation in the market is very much noticeable. Just below the market gap. I mean, it's clearly very important. And as far as tomorrow's market, let's measure that. Let's measure that lowest point. Oh yeah, that's perfect. Okay. So basically on the daily time frame candle, if the market happens to close exactly with this type of candle, I'm gonna use the bottom of this opening level of the candle to be aligned with a different level of supply demand, whichever is comfortable for you, whichever name or the block supply demand, whichever feels you more comfortable to jerk off to it. Like you can call it whatever you want to call it. I do know the ego has to be satisfied of calling it order block. Order block is grammatically a nonsense word. It doesn't mean anything. So whichever supply demand that point is going to be aligning with here on this daily open time frame. And this is also a concept you probably never seen. If this daily time frame candle opens up accordingly and it happens to close this way in terms of a rejection candle moving to the upside, and the market has a level of supply and demand aligning with it, with the opening candle of the rejection candle, it is going to be a level of confirmed entry. So I'm going to repeat it again. If the market has a rejection candle, and if the rejection candle's opening price is aligning with a level of supply and demand, it is going to be a confirmed entry. Easy as that. So I'm going to make sure to mark this up here. And that's going to be aligning with the H4. See, exact alignment. See that? Exact alignment, exactly at that point. So this here is going to be the main interesting area at this level. Already got a rejection from the support resistance. Already got the reasons for the market to move higher here. And of course, it is going to happen this way. If anybody disagrees, you may feel free to disagree. And the easy course of action is, of course, going to be like that. But of course, this, like, who uses a 500 pip stop loss? You obviously do not want to use a 500 pip stop loss. You want to use something more smaller. Preferably, you would want to use something around better confirming the entry. Because a 100 pip stop loss is statistically the best on guide. If you're gonna use a bigger than 100 pip stop loss, the problem is you gotta make too much of a profit to recover it. Like even though there also has to be a fair amount of pips used for the stop loss also to take profit. Like you have to be realistic with it. You just cannot go and you just cannot use whatever stop loss you want to use at some point, right? So there has to be some logical level of what you're expecting. And the logical sense is keep it maximum around somewhere around 100. Why do you want to keep it around 100 for stop loss? Because if you check what a daily range is, and if you start measuring what the market movement is creating in a single day, you're going to understand that usually one day's movement is typically maximum 100 pips. That's a typical daily range in terms of where the market is most typically moving in one single day. So, especially for day trading, And if you're trading on a perspective that's more of the short-term day trading perspective, you definitely want to make sure that your trades are not rolling over to the next couple of days. Like why shouldn't you be trying to let your trade roll over to the next couple of days? Well, it kind of depends on the situation. So I can also explain it. Um, Number one reason why you actually prefer making sure that the trade is not really held over days and days, because the higher the chances become that the fundamental of the market the next day it might be changing, the higher the chances become that the trend of the market just decides to go against you. And of course, each day a new fundamental announcement, a different government policy, it can be, of course, unexpected. So it is just not going to be good for you on the long run. Am I completely against swing trading? I'm not. Swing trading, it can work. However, it requires a complete different perspective from day trading. And the reason why it requires a complete different perspective, because your entire analysis, when in number one, you cannot swing trade based on using supply demand. Let's just make this clear. Using supply demand, you cannot swing trade. And number two, any of the common market concepts are just statistically not even working with swing trading. So if you are speaking of anything you see on the chart here, I wouldn't even be using it for swing trading. Each specific concept needs to have their own nature. Swing trading is, of course, done a bit differently. And also, not even mentioning going to the fundamentals. Like for the swing trading part, it is more of a long-term monetary policy decision. So let's imagine a way of how could you be swing trading. Let's say today we have a given data from the financial world, whichever financial data it might be, and that financial data might potentially create a long-term movement on a single instrument. That data may potentially be affecting the market for a month or 2 months, which is specifically the bigger news events. Those are, of course, affecting the market on a longer term perspective. And if you manage to trade according to that data of the potential financial data that you're getting, or the potential event that is, of course, expected to be a long-term movement, you can swing trade it. It won't be a problem. And of course, the market gaps are also a low risk, because if the market is highly driven by a major event in terms of economical data, global event, or any sort of important thing in the market that would be making you decide that you should have a long-term vision on it, it is going to be having far less of a risk of a market gap. When are we at the highest risk of the market gaps potentially occurring? Most potentially, market gaps may happen when the market is in a 50-50 range. This news event is telling this. Today we speak of this. Today we have a different news. Tomorrow we have another different news. If that's the case, of course you're going to be having an issue with holding trades long term, because holding trades long term are just not really realistic with the trend of the impact that the news event may potentially be creating. So that's the first thing. And so speaking of this entry, going back to a bit to the technicals here, um, okay, I'm still live, most probably. So the other thing I can tell you, 75%. Reason why. Okay, just a second. All right. So, okay, I should be still live. So let's speak of the win rate. Win rate, like any live trading session I ever did with Bootcamp, we barely even had any losses. I can even show my trading statements. The trading system I have is extremely consistent, extremely. But of course, like you can even just like if you have any doubts, like I suggest you to um make sure to follow this YouTube channel, because we're gonna have some live market opinions, like also like we had last time. You cannot see that this trade was winning. So let's go there. Let me show the trade. Like who calls the market live like this? Because I know a lot of traders do make good promises. There are a lot of good promises of making 10,000% on Robin's Cup. I know there are a bunch of good promises, but of course I rather be the trader who doesn't promise as much, and I rather want to be the trader who, let's go back here. Like, didn't I say that this is going to be moving downwards? Like, which trader is going to be giving a real market opinion like that? The only way you can give a real market opinion like that, see, it's all live, it's all documented, it's all publicly available proof. If you can trade live, and you can call a market direction. See, it's all there, all here. You just gotta see my YouTube channel. And of course, if I'm gonna go back to the market and show you what happened, you can see that perfectly from that day, the market completely dropped. And let me also go back to that chart because this is a different chart, and I'm gonna show that to you. So this is it. This was that analysis, and basically that's the trade. So it obviously went according to direction. So if I'm able to do this live in front of you, and I'm able to prove it, and I'm able to trade under pressure, because of course normally it would be a pressure to trade in front of others, right? If you're pressured, you cannot trade in front of hundreds of people. So that's probably one of the good proofs that this is of course working. Yeah, so that's what I can tell you. All right, so let's move forward and let's just speak a bit further here on the things we spoke of. So would you be executing this would you be interested in executing this immediately in the market as soon as the price is coming back here? I mean, technically you could, right? So there's nothing holding you back from doing so. But the only thing is you want to make sure that your stop loss is smaller and at least use the smaller stop loss. And also to use a smaller stop loss, you need a different type of entry. So for that reason, of course, this is just kind of used as a rough approximate ID of the market. And once we get there, it is going to be much more logical to make sure that we are also getting that. And just a final note before I would kind of wrap up the meeting, let's just have a final note of the risk reward. So let's go and speak of the risk reward here, because here we have a pretty decent equity simulator and quant funded, of course. So regarding risk reward, why is it like, I of course mentioned a moment ago that I much more prefer sticking with the smaller risk reward. Often the larger risk reward, it doesn't benefit you at all. Like there's no extra proof that the larger risk reward would actually benefit you. Like of course you could use the large risk reward. Like of course, great trader, trade 1 to 20, trade 1 to 50. Like I can also get those massive risk rewards. But is there any extra proof that it's better long run? No, there isn't. And of course, many times, guess what? Many times when you have a massive risk reward, those traders who trade with a very big risk reward, those are the same traders who have a very small win rate. Let me say it again. If you trade with a large risk reward, you're gonna have a small win rate. And when we speak of the statistical markets, and when we speak of trading psychology, do you think it's gonna be easier on you to have a very high win rate? If I'm telling you that you're like, why am I so confident in all of the market opinions that I'm telling you? And why is it that I can just go to the market, tell you this is happening, and it is going to happen without a single doubt? Because I know the system I'm using, it has a higher win rate. So I know that eventually, if I'm getting an idea of the market, it has to be good. And speaking of the risk reward, is it better for you to get a higher win rate with a slightly smaller risk reward? to get more confidence in the market? Or is it going to be better for you to win 10, 20% on each of the trades you're making and get 10 stop losses in a row? Like, how the hell would that be easier on your trading psychology? A lot of things in trading, it does come down to the psychological aspects. And that is, of course, all coming down to how you're managing your trading account, how you're managing risk. It all comes down to it. So, like, even with whatever you like, even if it's 1 to 3 is considered small, right? So 1 to 3 is like considered a mid ratio. It's kind of the small ones. The bigger ones, anything above 1 to 5 is the bigger ones. Like, see, even with 1 to 3, if I'm only getting half of the trades right, it's gonna be extremely profitable. Or even with this worse win rate, even with 1 to 3, I'm still profitable. So this is something I do recommend you to check. When we speak of the risk reward and the win rate, just go here. You can go click here, trading apps, open up the equity simulator on quant funded, and you can see what's working better for you. This is happening a ton. Like, if you already understand that, hey, you're already profitable with this one, why do you try to aim for, why do you try to hit a home run on every trade? So it is just something I do not understand from traders. But of course, this is something you need to grow up to. Like this is something you probably want to understand just by me saying it. You have to grow up to this. You have to grow up to the fact that you won't be rich overnight in one single trade. You have to build it through consistent trades over and over again, consistently trading. So that's what I can tell you regarding this. And I think that definitely could wrap up this meeting. So, guys, I appreciate the attention, very much appreciate it. And I'm gonna cut the meeting here. Thanks for joining. We're gonna, of course, I'm gonna make sure to attend to some of these live meetings to make sure some real value is put out on the public internet, because of course so far the only thing we see on the public internet on the forex space is just bullshit, false promises, fake trades, a bunch of bullshit. And of course I want to make sure that something is actually given that is actually real trades, actual live trades, actual market opinions, and of course making sure that I can leave an impact on the industry.